Good morning, ladies and gentlemen. Welcome to the INCE Group PLC's AGM and investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type your question and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to David First, Chairman of the INCE Group PLC. Good morning, David.
Good morning and good morning, everybody. I'm David First, Chairman of the INCE Group PLC, and I would like to welcome you to the 2020 Annual General Meeting of the company. Before turning to the formal part of the meeting, I would like to say that this meeting is being held under extraordinary circumstances, and my fellow directors and I are truly sorry that we've had to take the unprecedented step of conducting this AGM as a closed meeting. We understand that the AGM is an important forum where state shareholders get the opportunity to meet and ask questions of the directors in person. And I hope you will consider that the facilities we have put in place for questions to be submitted online and answered at this meeting are an adequate substitute under the circumstances. My fellow directors and I will try and answer as many of these questions as possible after the conclusion of the formal business. Although the meeting is not open to all of our shareholders in the usual sense, to comply with the company's Articles of Association, there is a physical meeting taking place at our Leconfield House office in Curzon Street, Mayfair. And I can report that we have 2 shareholders present in person at the meeting and who therefore form a quorum. As it is just after 11 o'clock, we have a quorum present. I confirm that the meeting has commenced. I would now like to introduce those directors present today, either at the meeting or online, as follows. Myself, David First. I am the chairman of the group. I also chair the audit committee and sit on the remuneration and nominations committees. Adrian Biles, our chief executive officer. Adrian also sits on our nominations committee. Simon Oakes, our chief financial officer. Simon Howard, non-executive director and chairman of our remuneration and nomination committees. Simon also sits on our audit committee. And Peter Rogan, non-executive director. The agenda for our meeting today is as follows. Firstly, we will attend to the formal business of the meeting as set out in the notice of the annual general meeting dated the 1st of September. Then we will have a short presentation by Adrian Biles and Simon Oakes. The questions and answers will follow on to form the final part of the meeting when I will be putting your questions to the directors. I will now start the formal proceedings of this annual general meeting. The notice of this annual general meeting was posted to shareholders on the 2nd of September 2020. Accordingly, the requisite notice of the meeting has been given. Under the circumstances and no indication having been received to the contrary, I'm also going to assume that the notice of the meeting may be taken as read. As referred to in the notice, the voting today will be conducted by way of a poll rather than a show of hands. As required by Article 54, I, as chairman of the meeting, hereby formally demand that each of the resolutions before the meeting be decided on a poll. As chairman of the meeting, I'm also at liberty to direct how that poll will be taken. Each of the shareholders in attendance at the meeting has submitted their votes by proxy in advance, as many of you who are in attendance online, and my direction, therefore, is that the poll will be taken by way of a count of the proxy votes for and against each resolution. This means that every shareholder who has submitted a form of proxy in accordance with the instructions set out in the notice of the meeting will have 1 vote for every share of which it is a holder. Where I have been appointed as the proxy and no instruction has been given as to the exercise of the votes, I have exercised my discretion to vote in favour of the resolution. Accordingly, I will announce each resolution, and the full text of each resolution will be shown on your screen, together with a breakdown of the proxy votes for, against, and withheld. I will then formally declare whether sufficient proxy votes have been received in favour of the resolution to be passed. The results of the voting on each of the resolutions will be announced through our regulatory information service and published on our website following the meeting. I will now propose the resolutions as set out in the notice. Resolutions 1 to 7 are proposed as ordinary resolutions and require a simple majority to be passed. Resolution 8 is proposed as a special resolution and requires a majority of 75% to be passed. Resolution 1. Resolution to receive the company's report and financial statements for the year ended 31st of March 2020. The votes cast in respect of the resolution are for 40,166,593, against none, withheld 43,757. There having been a clear majority of proxy votes cast in favour of Resolution 1, I hereby declare Resolution 1 to be passed. Resolution 2. Resolution to approve the Director's remuneration report contained within the company reports and financial statements for the period ended 31st of March 2020. The votes cast in respect of Resolution 2 are for 40,114,672, against 81,404, withheld 14,274. There having been a clear majority of proxy votes cast in favour of Resolution 2, I hereby declare Resolution 2 to be passed. Resolution 3. Resolution to elect Simon Oakes, who retires by rotation in accordance with our Articles of Association, as a Director. Simon Oakes was appointed to the board as Chief Financial Officer in May this year. It is a recommendation of the UK Corporate Governance Code and a requirement of the company's Articles of Association that all directors should be subject to election at the first annual general meeting following their appointment. Accordingly, Simon Oakes retires at this annual general meeting, but is eligible to offer himself for election. A brief description of Simon's background and role is set out on page 28 of the 2020 report and accounts. The votes cast in favour of Resolution 3 are for 40,142,703, against 64,314, withheld 3,333. There having been a clear majority of proxy votes cast in favour of Resolution 3, I hereby declare Resolution 3 to be passed. Resolution 4. Resolution to re-elect myself as a Director. In accordance with the company's Articles of Association, I'm retiring by rotation and offering myself for re-election. A brief description of my background and role is also set out on page 28 of the 2020 report and accounts. The votes cast in respect of Resolution 4 are for 40,143,003, against 64,014, withheld 3,333. There having been a clear majority of proxy votes cast in favour of Resolution 4, I hereby declare Resolution 4 to be passed. Resolution 5. Resolution to appoint Safri Champness LLP as the company's auditor until the conclusion of the next annual general meeting at which accounts are laid before the company. The votes cast in respect of Resolution 5 are for 40,004,514, against 202,503, withheld 3,333. There having been a clear majority of proxy votes cast in favour of Resolution 5, I hereby declare Resolution 5 to be passed. Resolution 6. Resolution to authorise the directors to agree the remuneration of the auditor. The votes cast in respect of Resolution 6 are for 40,007,595, against 169,422, withheld 33,333. There having been a clear majority of proxy votes cast in favour of Resolution 6, I hereby declare Resolution 6 to be passed. Resolution 7. Resolution to authorise the directors to allot shares in the company. Before the directors are able to allot shares, they must first be authorised by shareholders to do so. In keeping with market practice and the guidelines established by organisations representing institutional shareholders, the maximum number of shares that may be allotted under this authority is limited to 1/3 of the present issued share capital. This equates to 22,846,970 ordinary shares, or £228,469.70 in aggregate nominal value. Unless renewed, varied or revoked, this authority will expire at next year's annual general meeting or on 29th of December 2021, whichever is the earlier. As explained in the notice of the meeting, the directors have no current intention of exercising this authority. The votes cast in respect of Resolution 7 are for 40,146,195, against 47,438, withheld 16,717. There having been a clear majority of proxy votes cast in favour of Resolution 7, I hereby declare Resolution 7 to be passed. Resolution 8. Resolution to disapply statutory preemption rights. Resolution 8 is proposing to give the directors authority to allot shares for cash without first offering them to existing shareholders in proportion to their existing holding of shares. In keeping with market practice and institutional investor guidelines, the number of shares to which this proposed authority relates is limited to 5% of the current issued share capital, which equates to 3,427,045 ordinary shares, or an aggregated nominal value of £34,270.45. Unless renewed, varied or revoked, this authority will expire at next year's annual general meeting on the 29th of December 2021, whichever is the earlier. The votes cast in respect of Resolution 8 are for 36,762,276, against 3,431,357, withheld 16,717. There having been more than 75% of the proxy votes cast in favour of Resolution 8, I hereby declare Resolution 8 to be passed. That concludes the formal business of the meeting. I now hand over to Adrian and Simon for a short presentation.
Good morning, everybody. This is Adrian Biles, the Group CEO. I hope that most of you will know who I am. I've been a solicitor for 30 years and I'm the founder and a 16% shareholder of the group.
Hello, and I'm Simon Oakes, the Chief Financial Officer, in role since May, but with the group since October 2018. I've got a background in the accountancy firms with EY and Deloitte, and have been in role, as I say, since May.
So I'd like to provide you with a trading update statement in respect of trading since the 1st of April 2020. The revenue for the 5 months to 31st of August is slightly ahead of last year, albeit it's slightly behind our original budget for the 2021 year. The overseas office revenues are ahead of last year's, with improving gross margins and contributing to the group. Naturally, COVID-19 has affected UK revenues, and we've set out here a number of specific examples of that in aviation, real estate and corporate, but shipping and dispute resolution have been more stable, more consistent. We continue to reduce overheads, and we've instituted a modest redundancy program in the wake of COVID-19 and are seeking further operational efficiencies. Our new practice management system has been rolled out now in the UK, and we're seeing the advantages of that integrated system coming through in the performance of the business. And as soon as we're able to, it will be rolled out across the international business. Travel restrictions are making that quite difficult to do from a practical point of view at the moment. Net debt position has improved since the 31st of March. Credit control is pretty good throughout the group, apart from Greater China, where there is a sort of cultural issue around the collection of debts, but that's a source of focus for the management to improve that situation, which we're confident we will do over time. And we're on track to achieve our expectations at the time the accounts were signed. We are well positioned for when normal trading conditions resume, although what normal means now, I think, is a difficult question to answer. Our outlook is that the new COVID-19 restrictions, the sort of, if you can describe it as a shutdown in the UK, has extended the uncertainties as it's come in just as we were beginning to bring people back to work. As you know, we've got a substantial business in South Wales and also a back office in South Wales, and that is tricky because South Wales is largely locked down. However, people are working very efficiently from home, and all of our systems are supporting that remote working very successfully. The Singapore office has been consolidated so that the international law practice has been integrated with the local offering. That improves the viability of the office and improves the regulatory situation in Singapore. Singapore is an increasingly important hub for us, particularly as Hong Kong becomes a slightly different place to trade than it used to be, in terms of it being much more sort of mainland Chinese. And of course, Singapore is not. Singapore is an independent state, and it's a very useful place for us to be based to face Southeast Asia. We do continue to successfully recruit very high quality lateral hires, and you may have noticed our announcement of opening a Cyprus office, where our senior partner, Julian Clark, is at the moment, and I know he's received his first instructions for that office while he's been there. We don't have any significant property commitments over 3 years. We've always been careful to minimize the liability for rent in all of our premises. It's very difficult to see and predict exactly how it will all fall out, but it does seem to us very unlikely that we will return to a situation where the majority of our people are expected in the office the majority of the time. There will be no dividend to be declared at the half year, but that is under consideration for future announcements, and we do recognise how important the dividend is to our shareholders. Overall, the business is robust. The group is well poised, but you know, on the front page of our report and accounts states meeting the challenge, and that is what we as a management team are working extremely hard to do. So in terms of our future expected communications, this again is another area where we've committed to improving our communications with the market. The half-year results announcement will be in early December. Further trading updates between December 2020 and July 2021. The results announcement for the year ended 31 March 2021 and July 2021, and the 2021 AGM in September 2021. But it does, it is the case that we want to communicate better. We want to provide the market with sensible updates of where we are. We want to make announcements where they are appropriate or necessary. And we're very committed to making sure that our news flow is appropriate and consistent. I'll hand over to Simon now for the financials.
Presentation of the slides that we prepared with the year-end investor meeting. The first slide, the financial highlights, just to pick out a couple of important points there. The year ended March 2020 was a strong but critical year for us. It was the first year of us being a fully integrated international group, and we continued the trend of significant year-on-year growth in revenue. We were just shy of the target of 100 million. We got to 98.5, largely as a result of the effects of COVID in Q4, which I'll come on to talk about. Our key measure of profitability, which is the adjusted profit before tax, which again I'll talk about in a little more detail in a couple of slides, was at 8 million, again just below the 10% we over time aim to achieve. Our adjusted diluted earnings per share were down on last year after the fundraise in February, but about 42% ahead of the equivalent in 2018. We generated 14.7 million of operating cash, and I'll come on to talk about some of the factors that are in there that affect that number in terms of one-off or significant changes from COVID and other items. Our net borrowings were at 9 million, which is a combination of our cash, our bank debt with Barclays predominantly, and also some operational liabilities, circa 2 million, which we fund each year to cover our professional indemnity insurance. And if you excluded that, you would get a net borrowing figure of cash versus actual bank debt of closer to 7 million. In terms of the operational highlights, as I mentioned earlier, this was a year of great progress for us as we see it. This was the first year that we operated as an international group across 8 jurisdictions and 3 continents. The INCE brand continues to be a strong brand for us and a key pull for both clients and for lateral hires, who've been a key part of our strategy in growing and developing the breadth of business and the breadth of our offering this year. We brought in more than 10 top-tier lateral hires across our jurisdictions, not just in the UK, but over in Hong Kong and in EMEA as well. And we have started to deliver on the promise of growing through collaborative selling, by which I mean selling services that we have in one jurisdiction into another jurisdiction where we weren't able to deploy those services previously, or where we didn't have access to that jurisdiction. A good example being a number of corporate restructuring deals that we've been able to sell in from London into our new INCE Dubai practice. We fundraised £14 million in February 2020. We were very pleased with that. I know it has come with some disruption in our share price, but it was a key and critical thing that we do it essentially as part of the final funding of the INCE acquisition, which had taken place in 2 tranches. The first completion of the UK business in January 2019, and then the second completion in April 2020. We've continued to roll out, as Adrian mentioned, our practice management system, which is internally developed and is our own software system, and we think that's very important for us in the long term. We are beginning to see the benefits in the UK in terms of far better real-time reporting on things like collections, on our lock-up balances, on activity levels, and it's been a very useful tool as we've gone through the ups and downs of the sort of current COVID situation. We do want to roll it out overseas, but as Adrian mentioned, at the moment there are some practical difficulties COVID has presented to that, although we are very much focused on doing that and think that that will drive significant efficiencies of operation and efficiencies of cost. We responded quickly to COVID. We are able to deploy all our people to work remotely across all of our locations. The rollout of COVID and its impact on our markets has been different by territory, largely related to what the particulars of the pandemic in any region was and what the local government response was. In Hong Kong and Greater China, it hit first, obviously, really in early February, and they went into quite a substantial lockdown then, which has to some extent eased, although there are still travel restrictions there that have not muted activity, but have contributed to some of the difficulties with meeting with clients easily and managing down the lockup that Adrian alluded to a minute ago, and I'll come back to shortly. In the UK, where we've had probably the most significant lockdown across the group, that came into effect in early March, and we continue to monitor the situation, given that changes, as was mentioned, are frequent, and we're clearly in a period of some uncertainty as how long the situation will persist. But nevertheless, we believe we have the right IT infrastructure and the right systems that we can operate effectively regardless of the circumstance. In terms of our profit and loss, I mentioned a minute ago our focus on adjusted PBT as our measure of profitability. It was at 8.1% this year. The reason we look at adjusted PBT, for clarity, is that our structure means that many of our partners are captured in a line in our annual accounts called non-controlling interests. The partner deal is a mechanical deal driven on particular metrics about the money that they bring in terms of fees as cash collected from clients in which they're the client care partner or introducer of work, and money that's generated or brought in on work they specifically do, so where they specifically themselves charge time, and that is a formulaic remuneration structure akin to a variable salary, really. And we choose to include that in the P&L for our measurement of profitability in the line partner profit shares, which you can see in the table. It's presented slightly differently in the statutory accounts down at the bottom of the P&L, which gives you a much higher operating profit figure. We feel it is more appropriate to treat it as it really is, as I say, a salary cost. We typically target 10% as the sort of margin we want to get to on adjusted PBT. We're a little bit below that at the moment. Our gross margin, we targeted about 45%. It was slightly beneath that level this year at 44.6%. The real reason for that being many of the overseas offices that we took on were in some form of turnaround and were needed to be brought back up to par as they had an established practice, but had suffered before we took them over from a period of fee earner attrition over maybe 2 to 3 years. We've done that turnaround very successfully in Hong Kong, which is now slightly above 45% for the year ended March 2020 and is continuing to trade strongly at the moment. That process is ongoing in EMEA, and therefore that slightly brings down that gross margin. Additionally, we target overheads to be 30% of revenue over time. We're currently running some additional costs in the UK that we ran for the first part of this year post the INCE acquisition, which was the rollout of a number of administrative staff in the UK who came with the INCE acquisition based in London, that we didn't require to continue on because we focus our back office and support function down in Cardiff. And also the dual running costs of 2 properties. The INCE business was based in Aldgate Tower pre-transaction. We were based down on the Strand. Our property on the Strand, we only actually exited out of the lease in November, so there was some dual run costs. There are also dual run costs of a number of suppliers that we took on at the time of the INCE deal, which over time were unwinding, although it would be some time until they're fully unwound. We also have higher overhead run costs in the overseas offices currently. And as I mentioned earlier, it will take us some time to manage them down. And our view is that the rollout of the internally developed practice management system is going to be the key tool through which we do that. Obviously, with the COVID restrictions, our ability to do that is slightly impaired at the moment, or rather slightly delayed. In terms of the revenue growth, clearly a lot of our growth is acquisitive at the top line. You can see from the bullet points on the left that however, there is an amount of organic growth, which I referenced earlier in relation to collaborative selling. We track that at about 5% in the year. However, the other key point that I'd like to differentiate, we don't include lateral hires in organic growth when we look at it. In Hong Kong, we took a team of 20 lawyers on, not previously linked to INCE, a separate team that came in the beginning of April last year, led by 3 partners. They've delivered around 7 million of revenue, 14% of the growth. We don't include them as organic growth. I can see the arguments either way for organic or acquisitive. I just think it's important to highlight that as a model for lateral hires, they're a very good template for the kind of growth we can deliver in a strong market. Finally, just to touch on the impact of COVID, it was felt in Q4 across our markets. In the UK, it did have a hit on trading. Our property and real estate sectors have been in a fairly difficult market really for the last couple of years, with various general elections, debates over Brexit, changes in the economy, and clearly COVID has not helped with that at the moment. It was largely concentrated to the UK in terms of trading. The bigger effects on the overseas were more to do with slowdowns in collections, but it's clearly the reason that it took us down just below where we targeted on the 100 million of revenue. In terms of cash flow, I think it, obviously and understandably a key focus for the business at the moment has been cash flow. I think the first thing to preface is this is a business that's gone through a near doubling of size through acquisition in the last year and then been hit by COVID. That is going to mean that any cash flow you look at is severely distorted around net working capital. And although you can see cash generated by operations of 16.6 million, which is the first subtotal in the table, and then down to the negative 2.2 million after lease costs and the NCI, which is the actual cash payments to the partners under their contracts. That includes a number of items that are affected by the acquisition. Firstly, the unwind of a large number of INCE acquisition costs, redundancy costs, dual running costs of staff, the rental costs of the close out of our old property down on the Strand and our exit of it, and the additional unwind of costs we've provided for that. Legal and professional costs to do with the deal and the completion of not just the UK but the overseas deal, and dual running costs, as I say, of various supplies we had to unwind over a period of time after taking over, particularly in the UK. Also, the funding of net working capital, both of the Hong Kong lateral hires and the team that we brought in there, as well as the overseas offices, which needed a level of support through last year. As we noted earlier, and as I note on the slide here, those are now cash generative and are increasingly improving their cash generation and their cash profitability for us. So over time, they will start to deliver, and I believe that trend will significantly reverse. Finally, in terms of COVID, as I mentioned, it impacted the UK quite significantly in terms of trading. It also did impact in terms of cash collections. We were hit in early March by a relatively sharp shutdown in the market for a couple of weeks, which is only a short period of time, but of course is in the period where it's our strongest time for collections as people come up to the year end, bearing in mind, as I mentioned, the partner model is based on not just the fees you bill, but the fact that you've collected them. And that caused us a significant hit, probably of the order of 2 to 2.5 million in the UK. And our lockup in the overseas was also significantly hit because, as I say, although the activity levels have kept up, and this does persist to this point, the collections at the moment have meant that the build-up of debtors, particularly in Hong Kong and the Greater China practice, our Beijing and Shanghai branch offices there, have significantly increased, and that has not yet unwound to cash. So if you took all of that, that's sort of the order of about 16.6 million based on the workings that we've done internally to look at it, and that would deliver you a subtotal where you can see the negative 2.2 actually closer to 14.4 positive, which shows you the kind of profile we think the business can, and over time, once we've worked through COVID, will start to have. In terms of our lockup, just to reference that point, because it's another key metric we use, lockup was actually quite good, in my view, for the group at the year end. It was at 96 days, that being a combination of the trade receivables, the amounts were owed by our clients that we billed them, and our work in progress, that being the amount of time that's been booked by the fee earners onto timesheets, but not yet billed to the client. It was 96 days at the year end, but that does contain a much lower lockup for parts of the group where activity levels have driven down the WIP balance in particular, and it is partly offset by the high debtor days over, as I mentioned, in Asia. Finally, I mentioned earlier our position on net debt. Just to confirm the position, we have banking really for the UK part of the group through a facility we took with Barclays that we took in December 18 when we completed the first stage acquisition, the acquisition of INCE UK. That was a 12.5 million facility, 6.5 as an RCF, which we've kept drawn for now. We drew it last June, and a 6 million term loan, which we're repaying. And importantly, we will continue to repay for now in order to bring that term loan down. There are scheduled repayments all through the course of this year. There's one tomorrow, and we'll continue to make that payment to continue to bring down net debt, even whilst cash is a key focus for us. Final point I'll just wrap up with on the slide. Obviously, I'm sure a key focus for people will be cash. As I say, our cash generation at the moment has been a function of where we are as a business in terms of making a very large acquisition and the distortions that puts on our cash flow. We believe that will start to unwind and become a much cleaner picture for people as we go along. One thing to say when we get asked questions about cash, we at the moment are guilty, I'm certainly guilty of perhaps looking at our business as a kind of a UK business. We are not a UK business, we are an international business. And what we're working towards is people understanding how we operate as an international business. I mentioned having UK only banking, and if you look at our cash balance, the point I would make is we are roughly an even 50-50 split on cash, UK versus the overseas, and that persists to this day. So we do have cash in the business. It's just about the location of that cash and the ebbs and flows between the UK and all of the other overseas offices. That is me finished on the financial slides, though. I hope that's been helpful and enlightening. I'd just like to hand back to Adrian.
Yes, thanks, Simon, for that. So just to summarise, the business is a strong international business. Our task is to leverage the premier INCE brand and our scalable platform to develop that business in a sensible and consistent way. The people are the assets, the people and the clients and the brand are the principal assets of the business, and we continue to attract and retain key talent. And we're building momentum in terms of expanding the range of services which we offer to clients. That is an improving situation. The collaborative sales model, the collaborative remuneration model is proving itself. The integration of the overseas business, in particular, the rationalization of the cost base in those overseas offices, is a priority. We've got a team working on that. And our job as a management team is to realize the full potential of the brand and the people who support it. And COVID-19 clearly presents short-term challenges, but the business has proven resilient so far, and we're well positioned to manage further impacts. And I do sincerely hope that there are no major further impacts coming, although, of course, we can't predict the future. Thank you very much.
That's fantastic. Thank you, David, Adrian, Simon. Thank you very much for updating investors there and obviously providing the opportunity to deliver your AGM. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of your screen. Simply just type that question and press send. But just while the company take a few moments to review those investor questions submitted, I'd like to remind you the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. Lastly, before I do hand back to David, Adrian, and Simon, I'd like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you will be redirected for the opportunity to provide your feedback in order for the company can better understand your views and expectations. David, perhaps I could hand back to you just to go through the Q&A, and if you could just read out the questions received and direct those to the team, that'd be fantastic. Thank you.
Thank you, Paul, and thank you, Adrian and Simon, for an excellent presentation. We received 4 questions in advance of this meeting, which we will take first, and then move on to the questions that you have submitted during the meeting. The first question was, the share price performance since the interims has been disappointing. What do you attribute this to, and what actions are management taking to address this? Adrian.
Thanks, David. Yes, we can't comment on the share price. It's the market's assessment of the value of the company, not the management's. Management is committed to achieving financial metrics which justify a proper market valuation. And it will be for the market to judge how successful we are in achieving that.
The second and third question, I think, were really covered in the presentation, but I will read them for the sake of good order. Can you please provide an update on the current financial year? Are you considering, if not already announced, the reinstatement of dividends? I don't think there's anything more to add on that. The fourth question was, in the last presentation, INCE stated that they agree that the communications with shareholders is important. This hasn't happened as yet, and shareholder sentiment is depleting, which is reflected in the share price. This was to a large extent, I think, covered in the presentation, but Adrian, do you want to add anything to that?
Well, David, thanks for that. And I did say earlier in the presentation that we intend to communicate with the market regularly, and I always caveat that provided that there is something useful or necessary to say. We have done so in August and September, and we expect this to continue. And we recognise that shareholder interest is in part driven by the announcements and news flow, and we get that, and we will do better.
Well, that concludes the pre-submitted questions. If we can move on then to the questions that have been submitted during the course of the presentation. I'm going to take the first 2 together. First is, are you comfortable with a cash position, or do you foresee a cash raise in the next few months? Is there any concern over the current cash position ahead of the foreseen strengthening of cash in the fourth quarter? Given the current share price relative to the price at which the last raise was conducted, I'd hope the extent of dilution to holders under equity issuance at current levels would be a serious concern. Adrian, do you want to take that one?
Yeah, I think Simon's going to take those.
Sorry.
That's okay. Thanks, Adrian. Thanks, David. I think the point is, obviously, cash is a key focus for us and a key concern. We've put in additional reporting tools to manage and monitor our cash collections and our performance. August was a slower month of cash collections, but we're seeing a significant pickup on that in September. And we're seeing much greater engagement from the wider business in terms of turning around and unwinding their debt books. And as I say, this is a business that at the moment is perhaps thought of as a kind of UK and an international business. It is an international business. We have cash around the group, and we are working hard to manage, the peaks and troughs in the UK in tandem with managing the fact that there is cash in other parts of the group. With regards to the question about equity raise, that is not something that we're considering at the moment. We are focused on managing the position, which we think we can do as we are. Importantly, I would point out we have not tried to get at the moment any, this is without any additional debt help. We haven't yet considered things like a capital repayment holiday. We're paying down the term loan we have and not taking any additional facilities. So I think if things came to a situation where we needed to look harder at it again, there are several things that we can look at.
There was another question related to cash. There was a lot of focus on debt earlier this year and third-party commentary on the balance sheet that was very negative, but understandable given the way it was presented. Are you addressing these third parties to correct these views?
Yeah, we're trying to over time. I'll take this one, David. This is really, I think, around the deferred consideration that's on the balance sheet. I think there is a general misconception that we need to address better through future presentations and information we give to the market around what the deferred consideration represents. I think there is an understanding in the market of it as a sort of a hard debt number, which it is not. It is a a contingent balance that is earned by vendors who are typically mainly fee earners in the business based on the work that they do. So to the extent that the revenue declines, the amount of deferred consideration that will be paid out will also similarly decline. And we are going to look at that hard again at the half year to see if our estimation, which of course, in order to meet requirements under an audited set of accounts, it is set really at what we think is the largest amount we would end up paying out, whether that really is the position now as we look at over the next couple of years as those balances run out. But as I say, I think our view is to see them and think of them as a kind of a hard debt akin to a bank debt is incorrect, given that they flex based on performance and are entirely performance linked.
Was a follow-up question from the same shareholder. To follow this up, it is the lack of understanding clarity that means INCE is trading at such a huge discount to the sector.
Yeah,
I think that's just a comment, really.
Yeah, and I think it's a fair. I think Adrian and me share the view. It's a fair comment, and one of the things we need to do through this year is to continue to explain that in the market as well as we can, and to illuminate the facts much better for the market, which we will do.
Was there another comment, which I think basically Adrian has already answered? Considering today's drop in the share price on the back of this morning's news and this presentation, the entire group is now valued circa cash levels raised in February. Any message to the market in the light of what appears to be a significant disconnect? Is there anything?
Well, I think we've already said it's not our job to comment on the market's view of the value of the group. It's our job to deliver decent metrics and to look after the business and the stakeholders in it, which is what we're doing.
The final question that has come through: will the directors put their money where their mouth is and buy shares? Well, if I can answer that, a number of the directors, and particularly Adrian, put a tremendous amount of money into the group in the fundraising earlier in the year. There is little advantage to the group in buying shares by the directors in the marketplace. Final question that has just gone through, and this is the last one that we're going to take. There must be a better way of presenting it. If you pay it all out, the group is performing very well. It is a win-win. I'm not quite sure I understand that.
Well, look, I think it's the same situation. We've had a complex history. We've grown very quickly. We've done a number of transactions, and in particular the INCE transaction, which is complex in terms of its structure, in terms of its financing. And frankly, the best job that we can do for our shareholders is to go on working as hard as we all do to see the benefits of all of that come through to the shareholders, of which we're significant ones. And the question of the deferred debt, the balance sheet, the deferred consideration, etc., are all quite technical issues which need to be explained and which need to come through in the numbers. And I do agree that it's a win-win.
That concludes the question and answers, and thank you to Adrian and Simon in particular for their helpful responses. It also concludes the business of this meeting. I therefore hereby declare this meeting closed. I'd like to finish by thanking all of our shareholders who have taken the time today to attend online. I hope that you will consider that we have done our best to make up for the change in format of the meeting that has been imposed upon us. Should you have any further or follow-up questions that you would like to put to the board, then you will be able to do so by email to cosec@incegd.com at any time. I think that is supposed to be appearing on the screen. The results of the meeting will be announced in the markets through our regulatory information service and posted on our website as soon as practicable. Thank you.
That's great. Thank you very much, David. Thank you very much, Adrian, and thank you very much, Simon, for updating investors today and making the opportunity to make yourself available for the AGM. Could I ask investors not to close the session? You will be automatically redirected for the opportunity to provide your feedback. If you access the meeting via our website, just a couple of seconds after the webinar ends, the feedback page will appear in front of you. If you access via the link sent in the email, again, a couple of seconds later, you'll be asked just to log in and pop your feedback in there. It'll be greatly received by the company. So do please take a few moments of your time just to complete that. On behalf of the INCE Group PLC, on behalf of the board, David, Adrian, Simon, and the rest of the board, thank you very much for attending today's meeting. That concludes